All right, one of my favorite strategies is selling a put. Get paid to buy a stock by selling a put. If I'm going to buy the stock anyways, why not sell a put? And instead of waiting for the price to come down to a certain point, say my trigger point when I'm going to buy, why not sell a put so that if it closes anywhere below that price on the expiration date, which I'll get to that in a second, why not just get paid to buy the put? I can get paid a premium to buy it. I'm going to go through some of the nuances of that. I'll go through a couple of examples, and then let's just jump right in and get started. Buying a put, if I'm a put buyer, I'm buying that insurance contract. I own an asset, and I'm going to protect it from something happening and it crashing and burning. As an asset holder, I'm buying insurance. As a put seller, I'm the insurance guy. I'm selling you the contract to take your risk. I'm going to sell you a contract on, we're going to use D.R. Horton for an example, on DHI, because I don't think DHI is going to go down that much further. I like the stock anyways. I'm willing to pick it up from you. I'm going to buy it from you if it falls to a certain price. I will buy your house, essentially. If something happens, if it crashes and burns, I'm taking that risk as a put seller. But I don't think it's going to crash and burn because it's a good asset. So I'm not going to do this on stocks that I think are going to fall. I'm doing this on stocks that I think are solid and have a neutral to bullish outlook. Couple of terms to think about before we jump in. Strike price. Strike price is at what point am I going to buy that stock from you? The premium is what am I getting paid to buy that stock from you? I'm taking your risk, so you got to pay me something depending on the amount of risk I'm going to take. Expiration date. How long is this contract good for? I like the 30-day mark, 30 to 45 days, because that gives me a decent amount of premium and time decay starts setting in. That the contract becomes more and more worthless over time. The closer I get to expiration and that stock is not anywhere close to my strike price, it's going to be worthless, which is what I want because I sold it for, say, $200 or $300. And at the end of the 30 days, if that stock stays up, that option becomes worth less and less, and then I get to keep all that premium. In the money. A couple of things about in the money. That is at what point we're selling the strike. At the money is another point which we're selling the strike, but at the stock price. So if the stock is selling for $125, at the money is $125. That's a $125 put contract. Out of the money is where it is below the stock price. In the money would be above the stock price. That's for puts. And calls, it's the exact opposite. The reason why we would do this, one, as a put buyer, I'm buying insurance. I am hedging against my downside risk. As a put seller, it's speculation. I'm thinking that the stock is going to go up. It's speculation because I have an outlook on the stock. The reason why we want to sell a put is to generate income. Do this every single month. I've got an outlook on the stock, and my risk is essentially a little bit less than just buying the stock outright. So I could buy DHI for $125, and my risk is that it goes down to zero. My risk in selling a put is that, let's say I sell a put for $120, my risk is that the stock goes down to zero. However, I got paid a little bit more than just buying the stock outright. So my risk is always going to be a little bit less than the stock buyer. But it's essentially the same as if the stock were to go down. There's a way to protect me through another strategy, but for the purposes of this video, I'm just going to show you what it looks like selling what they call a naked put. But I'm always going to be further ahead than the guy buying the stock unless the stock goes through the roof. If the stock goes through the roof, I don't get to participate in any of that because my strategy was to collect the insurance premium. So I do that every single month. That's my goal, is not to speculate on whether it's going to go to the moon. My goal is just to collect the premium. If DHI goes from 125 to 150, I miss out on all that. But that's okay because my strategy is just to collect the premium. So I can't be mad that I didn't buy the stock outright. My maximum reward, I only get to participate in the income. So if I only get $2.50 or $3, that's only $250 to $300 for selling that contract. That's all I get. So the way it works, let me go through the payoff diagram. Let's say I was just going to buy the stock outright. It's at 125. This is what it looks like. That's just buying the stock outright. I buy it exactly at 125. If it goes up, I make money. If it goes down, I lose money. If I sell a put, I'm going to reduce my cost basis a little bit. My break-even point now becomes this, but my reward is capped. Okay, because I'm only collecting the premium. I do not get to participate in the upside. That is the payoff diagram. So if I get paid $2.50 or $3, it reduces my break even down to here, right? But this part here is $250. If it goes down, I'm going to get whatever the stock price has gone down to plus $250. So here it is. I sell the put at 120. So this is where I'm selling it at. If the stock stays above, the put expires worthless and I keep the premium. It's exactly the same. If this was 130, it would be the same. It doesn't matter. I only get the premium. However, if the stock goes down, let's say it's at $118. The stock buyer, if he just bought it outright at 125, he's down $700. However, I sold a put. This is where I'm a little bit better off in the down. I sold the put at 120. I collected $265. So at this point, I'm only down $200 on the stock. Yes, because I said I would buy it here, so I'm down $200 on the stock. But I got $265 for my premium. So I'm really positive $65. My cost basis is $117.35. When I get exercised and this stock gets put to me, because I said I would buy your asset at $120, when it gets put to me and it shows in my brokerage platform, it's going to show that I bought the stock at 120. Yes, but I got the 265. So now my break even is 117.35. So I'm much further ahead than the guy who would have bought it at 125 because he would have lost $765. Me, at this point, I haven't lost anything. If it goes down to 115, yep, I'm going to buy the stock because I said I would buy it at 120. So the stock has lost now $500. That's a $500 loss. But I got paid the $265 again. So take 500 minus 265. It's $235 at a loss. I'm way further ahead than the guy who bought it for 125. He's down 1,000. I'm down 235 because I got paid to buy it. So the goal is on this one is hopefully the stock will rebound. I'm just going to show a little quick diagram here. The stock was at 125. It tanked. I got exercised here. Now the goal is, I'm going to show you on another chart, that the goal would be that it comes back up. I'm okay with owning the stock. This is a long-term play. This is DHI. They're a huge home builder. They're interest rate sensitive, but they're a huge home builder. When interest rates drop, we know that there's strong demand for houses. So for me, it makes sense to go ahead and sell some puts on it and hope that even it gets put to me because I got the premium. And eventually when the stock turns around in this scenario, I would collect the capital appreciation on the stock as well. So let me just show you DHI real quick over time. This is since the beginning of the year. Right here, this is January. In the very beginning, I was trying to draw there. So there's January. And look at this range that it stayed in. We're staying in between that 125, 110 to 145 range. I'm at about 115 to 127. That's 2 standard deviations from the mean, with the 20-day average being around 121. So if I'm selling something that's 30 days out, that's somewhere over here. So if I'm going to sell my put, now I got to figure out where am I comfortable with buying this stock if the stock were to drop. I like the premium of around 120. It expires in this range as long as the stock stays anywhere above here. If it drops and decides to do this, I collect the premium and I buy the stock. at 120. So it's a pretty easy strategy to collect income. And during earnings season, this is a great strategy. I'll create another video on that because there's some implied volatility metrics that kind of come in and affect the value of the premium, which makes it a great strategy during earnings season. With that, let's go into Thinkorswim. Here's DHI. Let me show you real quick how to make this thing happen. In this section are the out of the money puts, in the money puts, in the money calls, and out of the money calls. Since we are selling puts, I'm going to sell an out of the money put at around, let's see, at around 120, 265. Look at this. It's a 30 delta. That's a 70% chance or 68% chance of being profitable. All things being equal, all the data that is known about DHI, the economy, everything else, the market participants have priced the option such that there is a 70% chance that the stock will stay above 120. There is a 80% chance it stays above 115. So if I was a little bit more conservative and I said, I want the odds of an 80% profitability, I could go down here and collect this, sell this contract, selling this insurance contract. If I want a 10% chance, so a 90% chance of it being profitable or a 10% chance of it getting put to me, I could even go further out and sell it at 110. All things being known, there's a 90% chance of probability that I could at least make $65. And if that 10% odds of it getting put to me, I made $65 and I bought it at 110. And I believe this is a good stock to own, so I'm willing to do that. So I'm going to go back to my 70% odds and I'm just going to select here and sell 265. It has 10, but for the purpose of the video, I'm just going to do 1. There's my $264 profit minus trading cost. My risk profile is right here. You can see the same diagram as what I illustrated before. They have the odds of 71.29. Anyways, you get the idea. It's a pretty good strategy to implement. Here are my break-even points. This is just slightly different than what I illustrated. Oh, actually, it's exactly the same. Look, at 117.35 because the put is selling for 265 at 120. So this is a fantastic strategy to sell puts on. I love it. It's one of my favorites. I find my favorite stocks that I like, and then I sell puts against them, and I collect either a weekly or monthly income depending on how far out I put these strikes. So with that, if you have any questions, shoot me an email. Good luck. Thanks.